Hey there friends, welcome back to Master. Today we're diving into a super helpful candlestick pattern, the pivot point reversal, or PPR for short. Traders use this powerful pattern to help predict when a trend might reverse, so if you want to learn how to spot market reversals and increase your chances of making smart trades, hit that subscribe button and stick with us, we're going to break it all down for you. Let's start with the most important thing, what is PPR? Candlestick patterns can be divided into two categories, primary and secondary. Secondary patterns appear less frequently and are less reliable, but PPR is a primary pattern, meaning it's more consistent and has a stronger track record. It's made up of 3 consecutive candles, with the middle one being the strongest, often confirming the direction of the reversal. Depending on whether the trend is upward or downward, PPR helps you figure out when to close or open your positions. So what's the deal with PPR? It's all about identifying the moment when the momentum of buyers or sellers starts to fade, signaling a market shift. You can spot this pattern on charts with the time frames of 1 hour or more, and it usually looks like this. In a downtrend, a strong bearish candle appears. The next candle hits a new low but closes higher than the first candle's low. The final candle closes above the second candle's high, signaling the beginning of a trend reversal. Now, PPR is most often used to detect reversals in both bearish and bullish markets. For example, in downtrend, PPR indicates that the price might be bottoming out and about to reverse upward, an ideal time to open a long position. On the flip side, PPR signals that the market could be peaking in an uptrend, warning traders to sell or open short positions. Let's break down some real examples. Here's a scenario. We're looking at the Bitcoin USDT chart and we see Bitcoin's price dropping. A PPR pattern forms and boom, the trend reverses. Buyers stepped in, took control of the market, and the pattern played out beautifully. But in another situation, we see a similar Bitcoin chart, but this time the PPR does not lead to a reversal. This happens sometimes when buyers lack the strength to push the trend back up, so the market stays in correction. Now that we've covered how PPR works, let's discuss how to actually use it in trading. First off, remember, PPR isn't a magic bullet. It is a strong candlestick pattern, but it is not foolproof. You must always account for risk, especially if you're still learning the ropes. I recommend trying out 2 strategies that have shown excellent results with PPR. Let's break them down. Number 1. Volume confirmation strategy. You analyze the chart and use volume to confirm the trend reversal. Once the trend is backed by volume, you enter the trade and set stop losses below or above the lost candles. That's how you make the most out of the trade. Number 2. The RSI filter strategy. You pair PPR with the RSI indicator. We've got a video on that, by the way. RSI helps you filter signals confirming if the market is oversold, RSI below 30, or overbought, RSI above 70 or even 80. This way, you enter a trade at the trend's reversal, reducing the risk of false signals. To summarize, PPR is a valuable tool in any experienced crypto trader's arsenal. It helps you spot trend reversals and better grasp market dynamics. If you found this video helpful and learned something new, please like it and subscribe to the channel. See you next time!